Have you ever wanted to know more about mutual funds? Have you ever wanted to maybe know the pros and cons about mutual funds? Have you ever wanted to know why maybe if you're in a retirement account like a 401k and the like that you have the mutual fund choices you do? Well folks, you're going to want to stay tuned because today we're going to talk more about this in the coming segments, so stay tuned.
Retiring Well, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well, where we believe your best is yet to come.
Hi, welcome back to Retiring Well. Listen, today we're talking about mutual funds, and we're talking about the advantages and disadvantages of them. First of all, let's just talk about some of the advantages. Most people who want what they call professional management of their securities, when you're in a mutual fund, you have what they call an investment that is run by some individuals, or what we would call fund managers, who are experts in their field per se, or in maybe that sector that they're managing, and they're trying to decide what securities to hold in that mutual fund. Now, a mutual fund can hold a number of different securities. You can have a mutual fund that holds nothing but bonds, okay? You can have a mutual fund that holds nothing but stocks. You can have a mutual fund that holds both stocks and bonds. Okay? You can have a mutual fund that holds just sectors of the economy. For example, the healthcare sector. How about technology? How about consumer staples? All right? You can have a mutual fund that can hold a sector or can hold a number of sectors. You can have a mutual fund that just owns the S&P 500, which would be just the 500 largest companies in the United States. You can have a mutual fund that owns just the Dow index, which is 30 stocks. Folks, the point is that some of the advantages of a mutual fund is the diversification you can get. Now, how do I choose what mutual fund to do over another, or who to have it from? There's a lot of what you call fund families out there. You know, you got American funds, you got Putnam, you got Invesco. You know, you've got a number of these kind of companies. And what they do, they all have a number of mutual funds in their what we call fund family. And you have the ability to be able to choose among them. You can choose among them with one fund family, or you can choose them from a number of fund families. The point is that you have so many choices. There's thousands of mutual funds out there. And if you want to be diversified, then you have every opportunity to be able to pick from just a smorgasbord of different kinds of accounts. Now, let's get just back to the management of them. You know, the beauty of these funds, for example, let's say I'm in a large cap mutual fund. Now, by definition, that just means that's a mutual fund that's going to hold large company stocks. Okay? And let's say this fund family that has this mutual fund has this management team or investment team. Okay? And they're managing this fund with a number of large company stocks. So what are they doing? They're looking at the market, they're trying to find opportunity, and so they're going to be buying and selling large company stocks within that mutual fund. Right? Now, the beauty of that is that they are, let's hope they're experts in that field. And so you get the advantage of being able to buy that mutual fund, be a participant in that mutual fund, a shareholder basically in that mutual fund, and get the advantage of their expertise as they decide what to buy and sell. So that's a real advantage of mutual funds. The other advantage of a mutual fund, and you'll find this in a lot of 401ks, is they can't have thousands of securities that you can pick from within that 401k, but they'll have a number of mutual funds there with little different styles, maybe a large cap mutual fund, maybe one that just has nothing but small company stocks like a small cap fund, and they'll give you these advantages to be able to pick among a number of different ones. So you get the diversification of the mutual fund itself, and then you get the diversification of being able to just pick among a number of different funds. whether that be a bond fund, a stock fund, and the like. So folks, mutual funds can be very advantageous in this regard because you get the advantage of having, again, you get professional expertise in management, and you get what we call diversification, because every fund has a number of securities, and if you can spread it out among a number of different funds, I imagine the diversification you're getting with that. All right, I hope that gave you a good idea of why there's some advantages to mutual funds. Now stay tuned, because in the next segment, I'm going to be talking about the disadvantages of mutual funds, okay? So stay tuned.
Today's retirement challenges can be mastered. Knowledge is power, because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, Northern Michigan's financial advisors specializing in retirement planning with offices in Traverse City, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn how to use the new tax reform to your advantage, the best way to generate lifetime income, how to identify and manage financial challenges, how to reduce your tax liability and increase your cash flow, how to maintain growth opportunities and reduce risk, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, January 15th at Big Buck Brewery in Gaylord. Wednesday, January 16th at Boone's Long Lake Inn in Traverse City. Or Wednesday, January 23rd at Cadillac Grill at the El Dorado Golf Course in Cadillac. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Hi, welcome back to Retiring Well. Listen, today we're talking about mutual funds. I kind of talked about in the last segment, kind of what a mutual fund is, some of the advantages of having a mutual fund. But in this segment, I want to talk to you about mutual funds and some of the disadvantages. Okay, first one I can think of right off the bat are the fees associated with mutual funds. You have to understand that management, that professional management I was talking to you about that is behind every mutual fund, well, guess what? They have research departments. They have to pay for research, as they look at securities and the like. Well, there's costs associated with that. Now, a lot of mutual funds have to publish what those costs are. They actually call it an expense ratio. And if you get that document with a mutual fund, they call it a prospectus, and you look through the detail of that mutual fund, most likely you're going to find that expense ratio within that document. Now the costs associated with the mutual funds varies with the mutual funds and with the fund families. But most generally, when you're looking at a mutual fund, you'll see costs ranging anywhere from 0.5% all the way to 1.5%. They just vary. That is a cost you're going to want to know. Now, there's also costs that are associated with mutual funds that a lot of times you don't see. When they're buying and selling securities behind the scenes, well, those are incurring what we call transaction costs. And a lot of those costs just get attached to the security itself. Well, the mutual fund doesn't have to necessarily publish those because that's just the cost of the trade. Barron's did a study in 2013, and where they found the average expense ratio with all these mutual funds they were studying was 1.19%. The corresponding hidden costs were 1.44%. So when you're in a mutual fund, although you're getting professional management, and we talked about all the advantages thereof and the diversification, you could be paying anywhere probably between 1.5% to 3% in fees, depending on that expense ratio and those hidden costs. Now, a lot of you are saying, Larry, what do I care about the fees if they give me a greater net benefit, right? What if they get me 5, 6, 7% and maybe I'm paying 2, 3% in fees? What do I care? Well, in this kind of environment, a lot of the portfolios will analyze, let's just say, for example, that portfolio of stocks and bonds is getting interest and dividends. We call that yield. But let's say it's earning interest and dividends of, let's say, 2% as a general rule. And what if the cost of those mutual funds is running 2% or a little bit more? Where am I going to get my growth? The growth is going to have to come from the appreciation of those securities, the idea that they're going to grow in value, that they're going to buy it at one price and sell it at another. I'm going to talk about this later in our Chalk Talk segment, but that's where, when most of the growth has to come from the appreciation side, that's where you get most of the volatility. A second reason that you might not like mutual funds is you can't see what you own. There might be thousands of securities behind that mutual fund, and they're buying and selling, and you don't see the buying and selling. You don't see what you own. Now, a lot of times you can Google the fund, you can get their prospectus, and they'll show you maybe the top 10, maybe top 25 holdings. But beyond that, you can't see it. So sometimes it can be disadvantages because there's a lack of what we would call transparency. You can't really see what's happening behind the scenes when they're buying and selling. A third reason you might not like a mutual fund is the passivity sometimes of them. For example, if I'm in a large cap mutual fund, this is a mutual fund that has to hold large company stocks, right? That's their objective. Now, a 2008 comes along and the market drops to half its value. What does that investment team, that professional management of that large cap mutual fund, what do? Markets are tanking, they're holding stocks. Now, you'd like to think that they might be able to go to cash, right, to protect you. And a lot of times, if you read the fine print in the prospectus, it says they can do that. But you'll find most likely that when you follow a lot of these large cap mutual funds, especially like in 08, they basically all went down with the market because they're holding stocks. That's their objective. They're in it for the long haul. And so if you're somebody that needs that money now for retirement or needs it for income, and you can't afford to see it drop to half its value like that, then this is something you're going to want to pay attention to. Folks, in the next segment, I'm going to talk more in Chalk Talks about that volatility I was talking about with mutual funds and what you want to maybe be looking for when you're dealing with them. So stay tuned.
Retiring Well is now also airing on radio, bringing you insights from Northern Michigan's financial advisors specializing in retirement planning. Every Sunday at noon on WTCM AM 580. Don't miss Retiring Well Radio, every Sunday at noon on WTCM AM 580.
Retirement represents a fundamental change in your life. Yet most retirees don't match that with a fundamental change in their portfolios.
Centennial Wealth Advisory's core services are built around lifetime retirement income, fully integrated tax reduction strategies, and portfolio stability.
Contact us today for a complimentary, no-obligation initial meeting. We'd be happy to learn about your vision of retirement and to share our insight with you.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, Northern Michigan's financial advisors specializing in retirement planning with offices in Traverse City, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn how to use the new tax reform to your advantage, the best way to generate lifetime income, how to identify and manage financial challenges, how to reduce your tax liability and increase your cash flow, how to maintain growth opportunities and reduce risk, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, January 15th at Big Buck Brewery in Gaylord. Wednesday, January 16th at Boone's Long Lake Inn in Traverse City, or Wednesday, January 23rd at Cadillac Grill at the El Dorado Golf Course in Cadillac. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. educated financial decisions. Call 888-608-5825 today.
Hi, welcome back to Retiring Well. Today we're talking about mutual funds. Now earlier I talked about some of the advantages of mutual funds. You know, you get what's called professional management, right? These funds are vetted by experts who have a lot of resources at their hands, like research and development and the like. Another advantage of mutual funds is just the fact that you get diversification, right? These mutual funds can hold a number of different securities among a number of different sectors. And so you get tremendous diversification. And then if you're in a retirement plan, they typically give you a number of choices you can pick from in which to maybe kind of choose for yourself which kind of sectors or areas you want to be invested in. But some of the disadvantages we also talked about. Most of these mutual funds, because they're vetted by experts, and have a lot behind the scenes in making those decisions, guess what? There's fees associated with that. There's costs associated with that. And we talked about what some of those costs can be. In a lot of cases, between the costs they have to publish and tell you about and some of the ones that might be behind the scenes, you can be paying anywhere between 1.5%, maybe 3% in fees. We also talked about the lack of transparency. They can hold thousands of securities, and a lot of times you can't see them buying and selling. You don't know what you own. You might be able to go in and see maybe the top 10, maybe top 25 holdings if you look at their prospectus or not, or maybe Google it online, but you can't see what you own. And then the last reason is the passivity of them. You got to understand that a mutual fund in a lot of cases is going to hold by objective what it says it's going to hold, like one, holding nothing but large company stocks. And when a 2008 comes along and the market drops to maybe half its value, they're not going to go to cash. They're holding securities. So you might find that account going down. So those are the advantages and disadvantages, and there's many more. But I want to just talk to you about, these mutual funds and how they grow. There's basically two ways a mutual fund can grow. It can grow by the interest being earned on the underlying securities, especially if it's a bond fund. If it's a stock fund, it's going to grow because of the dividends that those stocks are paying. We call this, in the investment world, yield. That's the actual interest in dividends being earned on the underlying securities within that mutual fund. Now, so I've got interest and dividends coming in, but now how is it going to grow? Well, they're also buying and selling securities. Okay, the hope is, if they're running their fund like you want them to run the fund, is they buy a security at one price and then later sell it for a higher price. Now, wouldn't that be the idea? And we call this appreciation, okay? Now, it's in this environment, though, that you get your greater volatility, because sometimes they'll buy a security and bet wrong, because sometimes it can go down in value. This is where you get the volatility. So I just want to show you two funds here, both trying to target a 7% growth rate. They're both, by design, trying to get about a 7% growth. Now, this fund here is getting 2% in yield. That means, again, the interest and dividends being earned on the underlying securities, it's earning 2%. So if they're targeting 7% and they're getting 2% in yield, how much has to happen from appreciation standpoint? Well, it's 5%. Now, here's another fund that's also trying to target a 7% rate of return, but it's getting 4% in yield. So where's its growth going to come from in appreciation? It's seeking then to get 3% in appreciation. So if you look at the two funds and you're trying to determine which one is most likely going to be a little bit more volatile, you're probably guessing right, it's going to be this one, because this one has much less in yield. Now, throw in those fees I was talking about earlier. If we know we're getting 2% yield And we've got fees anywhere, eating most of that up. Now where's the growth going to come from? Now we're relying totally on appreciation to get most of that gain. We're over here, not so much. So folks, we can get behind any portfolio of securities, most particularly mutual funds, and tell people exactly what they're paying in fees. We can tell them, getting behind all those mutual funds, we can tell them exactly what they own. So I encourage you to call the number on the screen if this is something you want to know and understand, and we'd be glad to help you.
Listen, are you an employee who is participating in a 401k plan? Are you aware that in some cases, you'll be able to roll out of the plan even though you're still working?
Are you tired of the choices you have and possibly the lack of professional help in getting you to your retirement goals? If you're looking for an alternative approach to help you protect your hard-earned retirement savings, then we may be able to help. You may be entitled to an in-service rollout of your 401k plan.
A rollover to a self-directed IRA may be an appropriate solution for you. Contact us at Centennial Wealth Advisory today. Take control of your retirement. Centennial Wealth Advisory can help. Please call the number on the screen.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, Northern Michigan's financial advisors specializing in retirement planning with offices in Traverse City, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn how to use the new tax reform to your advantage, the best way to generate lifetime income, how to identify and manage financial challenges, how to reduce your tax liability and increase your cash flow, how to maintain growth opportunities and reduce risk, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, January 15th at Big Buck Brewery in Gaylord. Wednesday, January 16th at Boone's Long Lake Inn in Traverse City, or Wednesday, January 23rd at Cadillac Grill at the El Dorado Golf Course in Cadillac. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Welcome back to Retiring Well. We're happy that you're with us this day, and we're walking through some different scenarios, and you've heard Larry talk a lot about different investments, and mutual funds has been a big topic this discussion. John and I were sitting here having a conversation, and we thought it'd be really good to share, I think, a recent story that maybe we might like you, maybe it's not, but I think it's a great way to kind of communicate some of the stuff Larry's been walking you through and showing you and really put it into real life terms.
Right, and so Art, a lot of times you'll be calling us up and saying, okay, let's sit down together and talk through because I want to understand what exactly I have. And so a recent case here where we were sitting down with a couple and they came to us saying, okay, we know we've got this nest egg that we've tucked aside for all these years, but we don't really know what sort of risks we're taking. We don't know what the costs are that are involved, and that's where we have the tools available to ultimately dig behind that. And so we started in talking first with, we like to understand where people come from a risk standpoint, right? And so understanding, okay, where is your comfort level, or we like to call it your uncle point, where you say, okay, enough's enough. I cannot take any more risk than what I'm seeing going on. And so that was the starting block, was understanding that.
Right, and it's always amazes me when folks come in and they don't really know what risks they have. You know, they have this statement and they know they have X number of dollars and it's made or lost money depending upon what the markets are doing, but they really don't know what the I guess they use the uncle point, what the worst case scenario is, or even what the best case scenario is in many cases, not just about the bottom a lot of times. And you're exactly right. I think it's really important to have that done and to really walk through that exercise to understand, what is your true comfort level? And it's not just some worksheet that you fill out and says, oh, I should be risk 6 or 7 or moderate, conservative, whatever it is. It's a true gut feeling and an attitude of what that person's comfortable with.
Right, and we like to look at it in the dollars and cents. And so, in this case, the couple had $500,000 saved for retirement, and we ran through that scenario to say, okay, what is that point where you say, uncle, enough's enough, and basically it was at $50,000 or 10%, which is pretty common when we're looking at people that are getting right there close to retirement or in retirement where they're not as comfortable. And so we walked through that understanding, okay, that's where you stand. And we had the opportunity, they had gotten us statements in advance, so we ran through this Morningstar analysis to better understand, okay, what sort of risk exposure do you have currently? And Art, I'm guessing you wouldn't be too surprised when I say, okay, their exposure to risk was losing about a third in a matter of a 1 year's time.
Right, and we see this far too often. What folks want and what they have is disconnected too often, and that's, you may not notice it when markets are good, and you may be thinking, oh, I've done really well and things are really well. You notice it when markets are course south and they start losing, right? That's when you feel it the most. The other thing I don't want to forget here too, because it's an important piece of this conversation too, is you said risk and fee analysis. Now, John, talk to us a little bit about fees and how shocking that can be sometimes for folks.
Yeah, so I mean, you have your typical advisory fees. Us advisors, we don't work for free, and so they knew, yep, we're paying our advisor 1% a year, which is somewhat standard, is what we've seen. But then what we were able to do is look behind the scenes. They had a number of different mutual funds in their portfolio, like Larry's been talking about on the show today, and we were able to dive behind and really understand what those costs are. And so that came back a little surprising to them when we did that, and when they added up then those additional costs with the mutual funds, they recognized that in their case they were paying a little over 3% a year in total costs, not just their advisor fees, but then the behind the scenes costs with their different investments. And so that's where we were able to really have a conversation about, okay, what does that look like for you, and what do those costs add up to over time, over a number of years?
Right, and once again, just like I said earlier with the risk, sometimes you don't notice the fees because, well, if I'm making money, I don't see it as much and I don't feel it, but it's those years where the markets are flat or south, then that's where you really feel it. But folks, if you're sitting home today and you haven't had one of these done in a while, or really ever, a risk assessment, a fee assessment, if your financial advisor is not talking to you about what your true comfort level is with that risk, give us a call. We'd be happy to sit down, walk through it with you, give you that risk assessment, give you that fee analysis. It's a short time out of your day, and isn't your retirement worth a second opinion? Thanks for watching us, and come back and join us again next week here on Retiring Well.